What if I told you that the absolute most successful traders in the world actually go out of their way to avoid those massive, jaw-dropping overnight profits? I know, it totally goes against every flashy, get-rich-quick myth we constantly see online. But honestly, the reality is that trying to hit a home run on every single trade is exactly what keeps most people completely stuck. So what if the real secret to growing wealth is something entirely different, something that's almost totally ignored by the mainstream?
Welcome to today's Explainer. Okay, let's dive into this. We're looking at the compounder's mindset, scaling small capital into wealth. Today, we're unpacking the profound psychological shift you actually need to go from a struggling beginner to a consistently profitable professional. Look, this isn't about finding some hidden, magical technical indicator. It's about a highly specific, disciplined framework of operating. We're going to break down exactly how smart professionals cut through the noise, manage their capital, and use time to methodically build wealth.
Right off the bat, there's just this stark contrast in foundational thinking. Most beginners come into the markets completely influenced by social media, right? They're totally convinced they need a massive account balance to succeed, and they've got this intense impatience to be rich tomorrow. They're swinging for the fences, just hunting for that one jackpot trade that's going to change their life. But the professional reality operates on a completely different axis. Listen, capital growth is absolutely not about how much money you start with. It's entirely about how effectively you manage your risk, how strictly you control your impulses, and how you set up a system that lets compounding do the heavy lifting over months and years instead of days.
So Rule 1, protect capital first.
To really understand how the pros operate, we've got to look at the absolute bedrock of their rulebook. While new traders are constantly obsessing over potential profits, professionals are obsessing over sheer survival. 50%. The math of drawing down your account is it's brutal and unforgiving. Think about it. If you take a massive risk and lose 50% of your account, you don't just need a 50% gain to get back to where you started. No, you need a staggering 100% gain just to break even. If you drop from $10,000 to $5,000, you literally have to double your money just to get back to zero. This mathematical trap catches so many people off guard because, well, once you're in a deep hole, the psychological pressure to make riskier trades to catch up becomes almost impossible to ignore.
So the absolutely crucial point here is how we avoid stepping into that trap in the first place. And the answer? You protect the baseline. Risk only a small percentage of your account on each trade. Professionals execute this ruthlessly. They use strict position sizing and define their exact risk parameters way before they ever enter a position. By keeping your risk strictly limited, often to just 1 or 2% per trade, you guarantee that no single bad decision or even a weird string of losses can wipe you out. You live to trade another day.
Moving on to Rule 2, focus on consistency. Okay, so once survival is locked in by protecting your capital, your focus shifts to the engine of steady growth. Successful traders simply do not chase jackpots. Just consider Trader A. They make a massive 50% gain one month feeling absolutely ecstatic, on top of the world. But then, they lose 40% the very next month because their underlying strategy is just reckless. That is an exhausting, high-stress emotional roller coaster. Conversely, you've got Trader B. They're aiming for consistent returns, pulling in just 3% to 5% month after month. Now that might sound incredibly boring compared to the pure adrenaline rush of Trader A, but Trader B mathematically crushes the volatile trader over time, and they do it with a fraction of the stress.
Let's actually look at how this builds psychologically, because this sequence is truly profound. It's a chain reaction. Step 1, consistency. When you aim for small, reliable wins, you actually start achieving them. That leads right into Step 2, confidence. You start genuinely trusting your system. And that trust is critical because it eliminates the emotional guesswork that absolutely ruins most amateurs, which then allows you to maintain Step 3, discipline. You stop second-guessing the market and just stick to the plan. And ultimately, that unshakable, data-backed discipline builds Step 4, wealth.
Which brings us to Rule 3, the power of compounding. That psychological chain reaction we just talked about sets the stage perfectly for this next phase. If consistency is the engine, compounding is the rocket fuel that makes the whole vehicle go exponential. Compounding, at least in this context, means taking those consistent, boring profits and reinvesting them. As your account grows slightly larger, that same small percentage of risk translates into slightly larger position sizes and slightly larger returns. It's a slow burn. It takes years, not weeks. But that is exactly what separates the gamblers from the investors. It'll turn a small account into a massive one as long as you stay patient. Compounding mathematically rewards consistency, and it heavily punishes gambling.
Rule 4.
Master your emotions.
Now, of course, there's a catch, right? The math works perfectly, but we're humans. We aren't calculators. Your own mind is literally the single biggest threat to the compounding engine we just built. The source material hits the nail on the head here. Fear and greed destroy more trading accounts than bad strategies. It is such a powerful fundamental truth. You could have the most mathematically perfect, scientifically backed trading system in the whole world, but if you panic during a sudden market dip or get overwhelmingly greedy during a massive rally, that system is completely useless. The behavioral difference here is honestly staggering. When traders get emotional, they spiral out of control. They take a painful loss and immediately execute a visceral revenge trade out of sheer panic or frustration. They're desperately trying to make the money back while completely ignoring their own rules. On the flip side, the professional execution is calm, it's detached. Professional traders follow their data-backed plan regardless of the short-term results. They really don't care about the outcome of one single trade because they understand fundamentally that they're playing a long-term game of probabilities.
And that leads right into Rule 5. Think like a business owner. To maintain that emotionless long-term perspective, you need a fundamental structural shift in how you view the market. You've got to stop treating your trading account like a weekend trip to Vegas and start treating it like a scalable enterprise. Business owners don't just wing it, right? They rely on data. That means meticulously tracking your performance, analyzing your mistakes to find operational leaks, and actively improving your process by logging trades and reviewing historical data. Before you execute anything, every single move must have a clear reason, a strictly defined risk level, and a specific target.
Because if you ignore that structured approach, you fall right into this trap. Random trading creates random results. Actually winning a random trade based on a gut feeling or some social media tip is probably one of the most dangerous things that can happen to a beginner. Why? Because it reinforces terrible habits. It makes you think you have skill when, in reality, you just got lucky. And luck always runs out in the markets. A true business requires structure, intent, and measurable, repeatable processes.
Let's bring this all together. The process, creating extraordinary results.
Growing capital isn't about finding a secret, magical strategy that never loses. The traders who succeed are rarely the absolute smartest people in the room. They are simply the ones who respect the process. They're the ones who stay consistent long enough to let that process actually work. Small gains repeated consistently can create extraordinary results over the long run. It is fundamentally about protecting your baseline, managing your risk with absolute precision, staying aggressively disciplined when your emotions are screaming at you to deviate, and just letting the boring consistency of compounding lead to massive wealth over time.
Which leaves us with one final, incredibly important question to ask yourself today. Are you ready to stop gambling and start compounding? Because the very moment you make that foundational shift in your mindset, the entire game changes. Thanks for joining me on this explainer.